Welcome to the deep dive video update. And I always want to explain this because this video is a little bit different than the other videos that I post. Every week I look at hundreds of charts and I don't use all of those charts in the other videos. But I still put together a video with those charts because sometimes we might get some insight that we're missing that's not as blatant as on the charts that I use in the video. Also, there are some charts that are unique just to this video. And so I put this all together into this video, and we have to look a little deeper at these charts. And that's why I call it the deep dive video. This is being prepared for Monday, September 9th. I do have a thing called the SPX Investing Program. It's up, it's running. There's a link below this video that will take you to the website or to a video that talks more about the program. If you have any questions, feel free to contact me. And as I said, this is just a weekly deep dive video here. I do a number of weekly videos, but they all tie into the daily video. All right, so the first chart that we look at, I just use in this particular video. It's a range of the VIX. And we can go all the way back to 2004. And when the market's really under a lot of pressure, the VIX goes up into a higher range. Then when the market's going up, we go into a lower range. And then we were in a higher range from 2020 into 2023. Now, even though we're going back up right now, we have been going into a lower range with the VIX, and that tends to be more positive for the market. We just look at this to get an idea of where is the VIX in relation to itself, because it's more dynamic, and the moving average helps to measure that instead of just using static numbers. When they first created the VIX, it was with the idea that 12 was to the downside. That meant there was no fear. And 20 was to the upside. When we got above 20, that means there's a lot of fear. And there's still some useful analysis that we can do that way. But we also want to look at the VIX and see how it's performing over a period of time. Then we also measure the momentum of the VIX. And even with the down day that we saw specifically on Friday, where the VIX is coming in well above 20 now, but we haven't necessarily topped out as far as momentum. And I use an RSI based on 9 periods. And even though the VIX is going up, it's not giving us an extreme reading currently. Then we look at the VIX and look at another indicator that's attached to the VIX called the VVIX, or the VIX of the VIX, and do a ratio between the two. It's pretty much flat right now. As a general rule, when this is going down, that's more positive for stocks. When this is going up, that's more negative. And we do a VIX and a correlation of the VIX. Sometimes we may not be seeing things with our VIX studies that we do, but we might see it here. Well, we're not really seeing anything now. Even though we're coming up a little bit, we're well below this dashed line. We really pay attention to this when it gets up into this nervous area right now, but we're far away from it. And then we do a ratio between the volatility of bonds, which is the MOVE index, and the volatility of stocks, which is the VIX. And this is really going up now as stocks have been going down and bonds have been going up. So we're seeing that there's a rather disconnect between the two. They're not moving in tandem with each other. The VIX is really outperforming the MOVE index. Then just to keep an eye on where are we in relation to the previous all-time high set in early January 2022. Even though we fell this week over 4%, we're still up 12.24% from the previous all-time high. Then stockcharts.com has this thing called technical alerts, and they are based around the S&P and other stock indexes, as well as sectors within the S&P 500. And this gives us more of a visual look at, are things more negative or are they positive? Well, we read this from the bottom up, and I go through each day's alerts in the daily video. This shows the alerts for the entire week. And Monday was a down day, or excuse me, Tuesday was a down day. So we saw an awful lot of red. Then we saw some green or blue along the way. And then we saw quite a bit of red here in Friday's session as well, as it was a negative day. Stockcharts.com also has a thing called technical scores, And you can do this with a stock, with a sector, with an index. Well, I use it with an index, and I use 5 indexes just to kind of rank them, what's looking the best from a technical analysis perspective. And they're ranked on a score from 0 to 100, 100 being the highest. And then I show them what is looking best and what is looking worst. And I hit the wrong button there. But coming in first place is the Dow. Now, the Dow got hit this past week, just like everything else. And it just set an all-time high a little over a week ago. But even coming in at 64, it's still the best looking index right now. And this is actually pretty weak in and of itself. Over here in the middle to right-hand area, this is historical changes of these scores on a daily basis. And it's really been coming down lately, where it was well into the 70s. And in second place is the S&P 500, coming in at 58.3, also falling off lately, but holding up a little bit better than other indexes because there are 503 stocks in the S&P, and they balance each other out a little bit better. Then in next place here, third place, is the small cap index, as represented by the IWM Russell 2000 small cap ETF. And this is coming down too. Very low score right now at 26.9. When these are really looking positive, they'll be into the 90s, and that's when they're looking good. Well, now we're down into the 20s here with the small caps. And then we have the QQQs. Been a real leader. You can see earlier on in the summer, we were well up into the 90s and camped out there for a long time. Well, now it fell back as we hit that downtime in early August. We were bouncing back up, got above 80. Now we're really falling down to 23.7. And then in last place are the mid caps, and they were stronger earlier in the year, but now they've been showing some weakness, coming in at 23.3. Then we have a short-term rainbow chart here, just to kind of get a big picture look at the short-term trend. And we're coming down and dropping below all the lines in this rainbow. Now, what's measured here is a 10-period moving average all the way up to 50 periods. And the more we stay down below this rainbow, the more these lines are going to roll over and actually start to turn down. And that's what we're watching for. If we can come down here and then bounce back up quickly, a lot of damage won't be done to these lines. But if we continue to drop, we could see the short-term trend, which is now negative, actually turn more negative if we continue to be below the rainbow. And intermediate term, another rainbow going from 50 periods up to 100 periods, coming down, but you can see the lines are still pretty flat right now. It's going to take a little bit more time to show more weakness in the intermediate term. We're negative there based on other charts that we look at. But if we can bounce up out of this, then there won't be a lot of damage that has been done. If we continue to drop, eventually these lines would start to roll over. We also use a thing called the CMB composite, and I use this like an oscillator. I have a black line when we're looking extreme positive on top, and then another black line when we're getting extreme negative. And even though we're declining, so we're negative here, we haven't come to an extreme negative reading. Then this is the distance away from the 200-day simple moving average. And we really pay attention to this when we get up into the 15% range or so. That's where we topped out in July. And then we saw the decline going into the early part of August after that. Well, we've been bouncing back up, but now we've been dropping back down again. And then we do some measurements here. I go from the October 2023 low up to the current close, and we're still up 24.97%, so almost 25% since that low. But then we hit that top in July, and was also watching this. We were pulling back, and we got really close to that 10% level. And then that's when we saw the smart money really coming in and start to buy, and then that pushed us back up here. We're going to be watching that again. We're still measuring it from the high here. We might also use this lower high range here because we never came back and set a new all-time high. But if we continue to drop, we'll switch this over and say, okay, when are we getting close to that 10% level? And then if we do get down to that level, is the smart money coming in and starting to buy, or are they continuing to sell, which could actually drop us into correction territory? Then we look at Bollinger Bands, And there's many, many different ways to use Bollinger Bands. This is just one implementation right here, where we have a thing called the percent B indicator, and that measures when we're above or below the upper or lower Bollinger Band. We're not there now, but we're dropping below the midpoint of the Bollinger Band. So that is suggesting that things are more negative. As you can see, we're dropping off here. So if we do see a really extreme reading where we go either, probably in this case, down below the lower Bollinger Band, then that's when I would use this chart in the videos. Because when those things happen, they tend to not stay that way for very long. And we keep an eye on the S&P 100 and compare it to the S&P 500. Now, when we were really moving up, the S&P 100 was outperforming, and we use other charts to show that. Here, we're not really seeing any divergences necessarily. They're both going down. But lately, what's been happening is the S&P 100 has really been underperforming the S&P 500. And the S&P 100 are the biggest stocks in the S&P 500. So that just shows that the leadership that had been happening earlier in the year is not happening right now. A long-term rainbow chart going from 50 periods up to 250 periods, coming down into the rainbow, but it's going to take a while to really switch this over. Now, even though we're negative in the short and intermediate term on our daily charts, we're still positive in the long term. We're going to have to come down a lot more to have the long-term trend in doubt. And then we have a long-term oscillator here called the special K, and this doesn't trigger signals very often. That's when we cross above the moving average, or the red line here. And we crossed above this back in late 2023, and we've been above it ever since. That's why I don't show this chart, because it just doesn't change all that much. And then we have a weekly chart of the S&P on top, and we have the German DAX weekly chart in the middle area. There's not a real strong correlation between the two. Sometimes we look at this and go, oh, Europe and the US are more correlated with each other. Well, right now, not really happening. Then what we're also keeping an eye on here are possible fib retracements. And the reason I say possible is we measure this, I'm a little bit off here, but we measure this from the all-time high. We didn't set another new all-time high. And if we really start to go down, we'll be watching these different fib retracement levels. We got close to that when we fell. Here's the big down day, excuse me, on August 5th. But then we were able to bounce back up off of that because we were getting down to that 10% area. And there was other support that the market was hitting at that time. Well, if we continue to come down, we will keep an eye on this chart. Then a broad market measure where we use the VIX to look at the volatility of the S&P. The Vixen measures the volatility of the NASDAQ 100, and that's been going up too as the NASDAQ 100's been under pressure. Then we have the S&P on top, and then a ratio between the Qs, which is the NASDAQ 100, and the diamonds, which is the Dow. And then we look at the correlation between them, and they're having a pretty strong correlated relationship as the market's seeing more broad-based declines right now. We also keep an eye on the transports and their relationship to the Dow, where the transports are the red line here, and they've really underperformed for pretty much all of 2024, where the Dow's coming off of setting a recent all-time high. The transports have just been chopping sideways. That's a traditional Dow theory non-confirmation and a concern to us, but this can go on. It's gone on for most of 2024. So we just want to be aware of this non-confirmation, but it's not necessarily something we look at to make decisions. We keep an eye on the financial sector, and that's really been holding up quite well. Now, it was down in Friday's session, but it's still looking pretty good. And then inside the financial sector is the bank ETF. And even though this is pulling back now, it's still above its 50-day moving average, and we're still in an uptrend with the blue line above the red line. So this is looking pretty good for right now. We want to keep an eye on this because it was the financial sector and the banks and everything that led to the great financial crisis in 2007 going into 2008. And it was looking good back in 2007 too, and then fell apart as we worked through 2008. We don't know if something like that's going to happen now, but we just want to keep an eye on this nonetheless. Another relationship in the financial sector that we look at are the regional banks. Now, when this really took a dive down here, that's when Silicon Valley Bank came out with their problems in March of 2023. And then it looked like things were getting better. And then New York Community Bank came out and said, well, we're having some problems too. And that took this back down. We're still in an uptrend with this ratio when we compare it to the financial sector, but we have been pulling back lately. I look at this chart every day, and I only talk about it when something's really happening here. So for right now, we're just observing what's going on with this relationship. Then this is just for informational purposes. This is a long-term chart looking at the rate of change going back 250 periods. And even with the decline, we can see that we're coming down, but it's not necessarily falling apart in the long term yet. Here's another look, too, where we came up to this blue line, and that was giving us a little bit of a concern, and we've been pulling back, and we've had a really difficult time getting back to that blue line. And even though the market's been under pressure lately, we're not really seeing a big decline, at least yet, in the long term. We keep an eye on bonds, where we look at the long-term bond ETF. That would be the 20 to 30-year bond, where it's been going up. That's the blue line. Well, the S&P has been going down. And so we're seeing not a real strong long-term relationship here. It's more or less neutral. What we also keep an eye on is the shorter term correlation or relationship, and they're having a real tendency now to go in opposite directions. Bonds have been going up as stocks have been going down. We do that same kind of approach here, but we look at the QQQs instead of the S&P 500, and then we have the long-term bond ETF again, and they're also having a tendency to go in opposite directions. You can see here the red line's been going up lately, where the QQQs have been coming down. And we look at the US 10-year yield, and we subtract the German 10-year yield. And then in the middle area, we look at the US dollar index. And because we look at the relationship between interest rates and currencies, and also precious metals comes into that at some point, and we see that there's a pretty strong correlation between them. As interest rates have been coming down, both in the US and in Germany, we're seeing this line coming down. And because US rates are higher, that's why we get a positive answer here. And the dollar has been under pressure lately too. So they've both been declining. That means that the correlation is pretty strong between them. And then we're also watching the yield curve. Now, the 10 to the 2-year has gone back to being uninverted. It went above it a bunch of times, but then Friday saw where we actually went back to being normal again. And that quite often marks the beginning of the countdown to say, okay, are we going to go into a recession? And it can be 5, 6 months, can be a year later. So we don't really know how things are going to play out. Of course, people like to declare that they know what's going to happen. And there's a case to be made for either side. There's other charts that we follow that suggest whether or not we're going into a recession. And right now we're kind of split down the middle. There are some charts that say, yeah, we could go into a recession. There's other charts that suggest we won't. Well, it's the 10 to the 2-year that most of the market follows. Well, I also follow the 10 to the 3-month. And even though this is still inverted, since we're down in the red area, it has a ways to go to get back to being uninverted. Now, the 10 to the 2 went inverted first, and now it's switched back to being uninverted. And we'll have to see if it can stay that way, because it's just barely going back to looking normal here. It could slip back and become inverted again. But then it was the 10 to the 3-month that happened a number of months after that. And so it's going to take a little bit more for this to come back. You can see we're still pretty far away from getting back to an uninverted state. We keep an eye on TIPS, which are Treasury Inflation Protected Securities. These are what folks get into when they're worried about inflation and worried about interest rates going up. And over here on the left-hand side, back in 2021, these were really going up. Well, then, as inflation started to come back down and get a little bit more under control, we saw the 3 to 7-year bond outperforming, and that's when this ratio goes down. We pretty much have been chopping sideways. What we're watching right now is we're seeing this going down, and that means that inflation worries are subsiding. But we need to remember the context of this particular chart. Are we going down because inflation is under control, or are we going down because they're concerned about the economy falling apart? And we're kind of going back and forth right now. a month ago when we had the employment situation report that came in weaker than expected, and everyone was like, we're going into a recession. Well, then we kind of paired things up as we worked our way through August. Then this past Friday, we had another employment situation report, which came in okay, but was not as good as hoped. And that's why we're seeing this coming down here. If we really start to fall because there are concerns about the economy, that would be more negative for stocks. But if we're coming down because inflation's under control and the Fed is coming in to cut rates because they want to stimulate the economy, that would be more positive for stocks. And we look at the 10-year, the 2-year treasury yield here. Now, typically what has happened in the past is when this spikes up and starts to come down, that can give support to the S&P on a short to intermediate term basis. Well, we're coming down now, but it had been helping the S&P to go higher because usually stocks like lower interest rates. Excuse me. But now we have to think, is the context starting to change here? This has really been coming down, and now lately in the last few sessions and this past week we saw a real decline with the S&P. We're going to watch this relationship and see if it starts to change into something else. And then I have some things called possible positive scenarios. I really brought these out back in 2022 because we were really going down and we became oversold, and we had a number of charts coming together saying, okay, we could get a bounce out of this, and then we would bounce up and then hit some kind of overhead resistance and then resume going down after that. Well, some of those charts I use every day in the daily videos. Well, there's some other charts that I just show in this video because they're not really telling us anything additional right now. The first, I have two studies that look at the percent of stocks in the S&P above their 200-day moving average. This one I don't show as much because it's set up more like an oscillator. We look for an extreme positive or negative reading, which we're not seeing right now. Even though we're declining, which is negative, we're still above 50, so that is positive. So the long term, we want to keep an eye on that. If you have longer term investments, or if you set up hedging or protection, or you try to sell options to generate more income with your longer term portfolio, this knowing what's going on in the long term is more helpful. But right now, we're still positive here, even though it's been pulling back. We do that same basic thing here with stocks above their 50-day moving average, which is more intermediate term. Also setting this up like an oscillator, but we're not getting an extreme reading. And even though we're pulling back, we're still above the 50 level. That's kind of the line in the sand between positive and negative. We're at 57.2 right now. If we continue to see more weakness, and if this drops below 50, that would turn things even more negative. And we look at the mid caps. They're also dropping down now and really not looking all that strong currently. In fact, they've already dropped under 50. So they're actually turning more negative, which explains why at the beginning of this video, we have the mid caps coming in last place right now. And the small caps also seeing some weakness. They've been really disappointing in 2024. We were looking to break out at the beginning of the year and then various times throughout the year, only to have it stall out and pretty much give back all of those gains. We're wondering if that's what's starting to play out right now. But when we look at this indicator, we are dropping below 50. So we're turning more negative with the small caps. So thank you. I hope you found this helpful. I prepare this video not necessarily to be a standalone video. It's meant to be used in conjunction with the other videos that I do. So feel free to check those out and see if those other videos that I post are helpful to you. So have a great weekend, and I will talk to you in the next video.